You know, it's a beautiful day in Dallas, Texas. Even with all the uncertainty in the world and the economy, I don't know about you, but there's no place I'd rather be for what we do than Dallas, Texas. I feel very fortunate. I also feel fortunate, yeah, hey, we'll give that a hooray. I also feel fortunate that we have sponsors like Grant Thornton and DCEO that make today's program possible, so thank you. We'll go through the mission statement again. TREC's mission is to cultivate relationships in the commercial real estate industry to catalyze community investment, influence public policy, propel careers, and develop the leaders of tomorrow. That's a tall order, but TREC's up for it. We believe relationships are the lifeblood of career success, community investment, and civic responsibility. Before I introduce our moderator and speakers, we have a couple of announcements. Today's a very special day for our region. It's North Texas Giving Day. I know that's not the first time you've heard about that. North Texas Giving Day is one of the largest philanthropic events in North Texas. I encourage each of you to donate to TREC community investors and support our neighborhood revitalization, the Affordable Housing Loan Program, and other economic development projects in our area. You'll find a QR code on your tables linking you to the North Texas Giving Day page, and it's supposed to be on the video screens also, maybe. It's on your tables. In making our donations, we join other TREC members and TREC member companies like NextBank and Bank of America, as well as the Addy Foundation, who all recently and very generously provided grants. These grants further TREC community investors' mission of partnering with underserved communities and local organizations to create lasting economic impact to energize our Dallas neighborhoods and to change lives. Please consider donating today. I hope you all are as excited as I am for Fight Night 33. I don't know how many of those I've been to, a lot. The theme this year is Breaking Ground. Our annual black tie boxing extravaganza is sold out, and rumor is we have a few ALC class members here. Raise your hands. Do we have any? Great. Oh, you're going to get it. Hey, you know, you show up. That's half the battle, right? So step over and buy a raffle ticket from this gentleman and win some great prizes. You can also find on the website a list of frequently asked questions, the answers to those, and other resources about Fight Night. Before we know it, it's going to be Election Day, and in addition to all the important political races going on, the citizens of Dallas will have the opportunity to vote for the ballot initiative to devote a portion of the hotel occupancy tax to the revitalization of Kay Bailey Hutchison Convention Center and Fair Park. I bet Dupree will probably slip a word in or two about that during the speech. If you get a chance, stop by. If you did not get a chance to stop by the booth at check-in, I encourage you to take a flyer and learn more about the proposal. Remember, it's the vote that costs us as residents nothing, but can bring meaningful change in our ability to sponsor and host conventions and to restoring our treasure of Fair Park. Finally, note that our next Bank of Texas Speaker Series will take place on Wednesday, November the 9th. It will be our annual Capital Markets Update with Mark Gibson of JLL, so you won't want to miss it. If you've attended before, you know what a quality program that is and will attend again, I'm sure. Tickets will be available in the next few weeks. Now let's get on with the show. I'd like to welcome one of my very favorite people, and I'm sure many of our moderator, Christine Perez with DCEO.
Thank you, Kim. Well, if you guys know Kim at all, this is her favorite time of year because she is the region's most passionate college football fan. She has a room with multiple TVs, and everybody knows not to bother her on game day Saturday. So it's always fun to talk about various teams with her. Go Blue. All right, well, thank you all for joining us this morning as we discuss one of the most fascinating sectors in commercial real estate. The team at TREC, as usual, has pulled together an exceptional panel, and I know we're all looking forward to hearing what they have to say. So we'll be saving a few minutes at the end for questions and answers, just in case we don't get to something that's on your mind. This morning's Hospitality Summit is the latest in TREC's Market Matters series, and we are so fortunate to have an organization like the Real Estate Council here in Dallas. Its impact on the city under the leadership of Linda McMahon has been profound, and there is so much more to come. So at D Magazine Partners and DCEO, our mission is to make Dallas even better, and that's what the Real Estate Council does every day. So we're very proud of our partnership with the organization. All right, enough about that. Let's get to the panel. I'd like to welcome to the stage our three panelists this morning, if you guys could come on up. John Beret, he's Managing Director, Global Real Estate Investment Banking firm East Hill Secured. Kevin Davis, he's the CEO of JLL Hotels and Hospitality, and fortunately for us, he just happens to be in town. New York is his home base. And Dupree Scoville, who's Managing Partner and Chief Investment Officer for Woodbine Development Corp. So I guess I'm going to move over to the chairs. All right, well, welcome guys. Thank you so much. So let's get started by kind of setting the stage. If you could each just briefly tell us about yourselves and your organizations and your roles, and then everyone will know a little bit more about the perspectives that you're going to be sharing today. So Dupree, let's just start with you.
Sure. Good morning. My name is Dupree Scoville. I work with a company called Woodbine. We've been around for about 50 years. It started as a partnership with the Hunt family. We have investments in industrial and multifamily and office, but our primary space is hospitality. Hopefully you guys have been to Lost Pines or Hyatt Hill Country or La Cantera or some of those. We're a team of talented individuals who like to compete and win. And we are in, I guess we've been in about 20 states, and we are across the board from Hyatt to Hilton to Marriott, from select service all the way up to luxury resort. For us, our world is it's about partnerships. It's about working with other developers, working with investors, working with lenders. We kind of talk about dealing in the currency of trust. That's kind of our world. That's kind of where we camp out. So hopefully we'll put another 50 on the board. But now that my brother and I are involved with the company, it probably won't be long before we mess it up. But see what happens.
So you like to compete and win. That's so unusual in Dallas real estate.
Yes, that's unusual.
All right, Kevin.
Great. Good morning. Kevin Davis. I live in New York, but I'm from New Orleans, so I want to be very clear about that.
Street
and have lots of relatives in Texas, so it's great to be here in Dallas this morning. To that point, Mark Gibson has been trying to get me to move to Dallas for some time, so doing events like this certainly goes a long way toward that cause. But no, it's great to. What's that?
The water's warm. It's nice
hey,
here.
let me tell you, these winters are wearing on me after some time. But again, great to be here. I lead the America's Hotels business at JLL. I've been at the firm now for about 10 years. My prior life worked on the lending side in capital markets, spent some time on Capitol Hill working as a lawyer. I've done a bunch of different things in addition to hospitality. But again, we are a leading commercial real estate brokerage firm. We've got a global practice more broadly in capital markets, but also in hospitality. So the way we like to think of ourselves is if you are interested in owning a hotel and or own a hotel, we can help you throughout every aspect of the life cycle of your ownership. From the time you say, I want to look at a deal, we can help you on the buy-side advisory. We can sell you a hotel. We can finance your hotel. We can provide strategic advice and asset management during the time of your ownership. And then, of course, we can also help you dispose of the asset. So, again, helping you throughout the life cycle of hospitality. Ownership, again, my background historically has been on the financing side for 20 years. More recently took over leadership of the broader group, which includes our financing business, our investment sales business, and our asset management business. So happy to be here in Dallas this morning and look forward to having a robust discussion with my colleagues. And interestingly, we were each just at a major lodging conference over the past couple days, so I think we'll have some insights after meeting with, 30, 40, 50 folks over the last 2 days, so.
Yeah, that's fantastic timing.
Yeah.
What about you, John?
Thank you. John Beret, I'm here, local in Dallas. Just joined Eastdil a little less than 6 months ago after a long run actually at HFF/JLL and helped start the hotel practice here with that firm, and have now been tasked with helping Eastdil grow their Sunbelt hospitality practice. So really kind of Phoenix to the Carolinas and everywhere south. And we do a lot of the same things. So we help on the financing side, we help on the disposition side, we raise equity for recapitalizations, joint venture equity and whatnot. So we've been very active in a lot of different projects, and so I think we all have a good sense for what's working and what's not. We'd love to tell you what we're seeing in the market today.
Awesome. Well, let's get started with that. Okay, we'll start with a question on everyone's mind in general. How is the hospitality industry faring as we all emerge from the pandemic? Want to go first?
Sure, I'll go first. It has sucked. That's a technical term. It has been, the past 2 years has not been great, but we are seeing light at the end of the tunnel, I think just in time for a recession. So I'm not sure what'll happen, but we are seeing some improvement on the transient side, business travel. We are seeing a lot of group business start to come back. But I do think we're going to see some softening here in the next year or so, which when we had this prep call, we probably weren't as confident about what was coming. Now I think we have a little more visibility into that. So, but I think, look, it has been interesting because, anytime you have a crisis, right, it forces you to think differently. And our team has certainly done that, where we have kind of gotten into the hotels and really, even in some ways, helped our operators think about how to operate these hotels in a different way. And a lot of those lessons that were learned and cost-cutting measures will be permanent, some of which travelers aren't going to necessarily want or appreciate. But as you guys have seen, what you're paying for hotel rooms is going way up. And sometimes the value, actually what you're getting in the product, is not necessarily commensurate with that. And so that's at least a trend that we've seen historically happen in hotels, where pricing for hotels has outpaced inflation. And so that for us, that is actually a positive of our industry. We can hedge literally by the hour, when in other forms of real estate, industrial or office or other things, you don't have that ability. You're locked into a lease. So there are some benefits to that. What do you guys think?
Yeah, I agree. It's interesting. When I'm asked this question, I always ask, well, do you want me to look back or do you want me to look forward? Because depending on the direction I'm facing will dictate the answer. I mean, look, from a backward-looking perspective, Dupree is right. I mean, the operating fundamentals over the past couple years, going back to the start of COVID, have been challenged. 2021 and 2022 have been good recovery years, such that from a RevPAR basis, we are actually back up to beyond where we were in 2019, which is the benchmark that most hoteliers use to determine how operating performance is. So we're up about 5% on a RevPAR basis compared to 2019. From a transaction volume perspective, which has been interesting, I mean, last year, 2021, was the second largest transaction volume year in hospitality. Wow. 2015 was the largest. I think 2015 was about 48 billion. Last year was about 40 billion. This is domestic in the U.S. I think generally 25 million or larger. This year, through the end of July, we're at about 23 billion, which for that time period is the highest it's ever been. That's up about 86% compared to 2019, just in terms of transaction volume. So a lot of trades happening, a couple large portfolio deals that have gotten done. There's another large portfolio deal that's been announced and approved that'll close in October. And actually, interestingly, there have been a record number of single asset or just individual trades. So there have been about 715 individual trades through the end of July. So busy year, again, in the rearview mirror, looking forward for a lot of the reasons Dupree mentioned, in addition to what's going on with the Fed and interest rates. Transaction volume has started to slow over the past couple months. We're still seeing strong operating performance, but the expectation is that as we potentially move toward a recession, we'll see declining operating performance. But right now, it's interesting. It's a tale of two worlds because operating performance is generally very strong, but the capital market's very challenged. So when hoteliers say, I want to go out and sell or I want to go out and finance, my asset's doing incredibly well, you look at the capital markets and you're sort of caught up in the macro situation with higher rates and concerns about inflation. So it's a little bit of bifurcation there. But again, it should be a very interesting next 6 to 12 months as we move into sort of a higher rate environment.
Yeah, the only thing I'd add is, Dupree, I understand it sucked in 2020, but to Kevin's point, 21 and 22 were actually pretty darn good years for the hotel business. And I'm actually much more optimistic. I mean, I can't see a scenario where we go back into what the hotel industry went through in 2020 with global travel completely stopping. And the fundamentals are pretty phenomenal, especially in some of your leisure assets and even picking up in urban cores with, like New York, right? We were there a couple of weeks ago. New York is back. It's after Labor Day, corporate's back, people are back in the office, group is back. The social events, Fashion Week was going on last week. It was, unbelievable. So I think that the other great thing about the hospitality business is we've got more liquidity and more people trying to get into hospitality today than we've ever had. So from a liquidity standpoint, equity, lenders, we actually, I think we have some runway if we don't, go into a deep recession. But right now we do have a pricing problem as far as debt is just really expensive.
Yeah.
Mispriced.
Mispriced.
Yeah,
Mispriced.
I agree. Expensive and mispriced.
Let's follow up on your comments about transaction volume. So what's driving it? Like, how would you describe the buyers and the sellers? What types of properties are getting the most attention, and how would you describe it? Who's looking to sell? Who's looking to buy?
Yeah, it's a great question. Look, I think heretofore there's been a strong bias towards drive to leisure resort assets. Those were the first assets to recover post-COVID. You had, coming out of the pandemic, there's revenge travel. People want to get out. They want a social distance. So beach destinations, resort destinations, places where people could social distance were the first to recover. And on the strength of that strong recovery, we've seen investors gravitate to that product because it feels like there's some downside protection. I'd say over the past 9 to 12 months, we've started to see a recovery of urban assets. So if you look at the top 25 hotel markets, generally the big cities, they fared incredibly poorly during COVID. I mean, most are in blue cities, a lot of union. International travel is a big driver for a lot of those places, and that fell off. So those assets really struggled. So I'd say over the last 9 to 12 months, we've seen a recovery in urban, more investors starting to look at markets like New York and Chicago, Boston. San Francisco is a real laggard, but some of the big cities people are starting to look at. So I think the other part of your question was the reason why. Look, I don't think we've never had a recession within hospitality of the magnitude that we just experienced. And so I think investors have been attracted to the space because of the recovery that we're experiencing, but also to the point that Dupree made earlier, which is it's a phenomenal inflation hedge. So even while multifamily industrial, which was priced to perfection, as soon as rates started to move, you started to see pricing be affected to the negative in those asset classes, not necessarily in hospitality. I mean, over the course of a closing period, you may have a buyer go exclusive on a deal 60, 90 days later, NOI may be up 5 or 10%. Yeah. And so that'll offset the rising cost of debt. So I think the inflation hedge reason is another reason why people have been attracted to the space.
The other thing on that point is hotels have always priced at a unusually wide margin above the other indices in the risk-free rate. So we've got a little more cushion for some of this spread gapping out. But again, it's in our view, it's have and have-nots. There are markets that are very liquid and assets that are very liquid, and then there's markets that are really, really tough. I mean, Chicago right now is next to impossible, even if you've got a really strong performing asset, of which there's only a couple. It's tough to get, for a variety of reasons. It's tough to get institutional capital to go there. Too many people have lost too much money there. But Kevin's point is on, like leisure is still on everybody's radar. The only thing better than drive to leisure is private jet to leisure, because that is absolutely recession-proof. And so when you're working on assets like Montage Laguna Beach and Four Seasons Jackson, those they're at all-time record profitability, and they're not slowing down.
All right, Dupree, I'm going to talk with you about another topic that's on everyone's mind, and that is rising interest rates. How's that impacting the industry, and what do you see going forward?
Well, it's a challenge for sure, I think, especially on the buy side, but what our industry is dealing with that I think is unique is you have, when we just went through COVID, you have a ton of liquidity that came in the market. You have a ton of people that have now raised funds anticipating distress during the pandemic that didn't really happen. So then when interest rates go up, the expectation now after what we just went through is that you're going to start to see banks want to take assets back. But the reality is that no bank wants to own a hotel, for one. But even if they do, there's a floor that's been created just by the amount of liquidity that's coming into our market. So because there's so much equity that's been raised, it will create a floor that really will set pricing above where a distressed mark will come. So I think it's one of those things where the deals that are going to get done right now, in my view, are going to be REITs because they don't need debt. And then the sponsorship groups that are just exceptional, I think they're the ones that are going to be able to get debt in this type of market. But one way or the other, something's got to give. Pricing, if you're underwriting an asset, CapEx price, you're pricing your renovation, that's going to be up by probably 20%. You're going to have to underwrite some type of softening that's happening over the course of the next year or two. The only thing that gives is returns. And so the reality is, like, with the amount of equity that's coming into the space, it has to be something where that equity is willing to say, we'll just take a lower return. I don't see any other way to get there. In fact, unless we're doing it wrong, that's the way we're looking at it.
I mean, that's the way the math works. And I think Dupree is right. Look, I'll go on a limb as an intermediary and say this. I do feel like we are seeing a secular shift in rates and where rates will be. I've told our junior people that maybe weren't around before the GFC and quantitative easing. The past 12 years of quantitative easing is the exception, not the rule. We're just going back to the way things were before, where you had treasuries 4%, 5%, and even then, I mean, if you compare that to the 80s and 90s, that's still low. So, a Fed funds rate at 4.5% or 5%, while shocking to people that, haven't been in the industry for a long time, that's where things were. I remember back in 04, 05, I mean, we were doing hotel loans at 5.5%, 6%, 6.5%, and owners were making money, lenders were making money, so you can exist in that environment, but credit spreads were different, right? So that's the one thing that has to change. So to Dupree's point, we're seeing a secular shift in the pricing of debt. We haven't yet seen that shift in the pricing of assets. And so at some point, something has to give. I mean, and to John's point, I mean, they're in the market with an amazing portfolio right now. And I know, I mean, it's full pricing, right? But it's forever assets, and people are saying, I just want to own this. It's recession-proof. And so there's a bit of a disconnect here. But so in my opinion, the next 6, 12, 18 months are going to be incredibly fascinating to see how this dynamic plays out.
Yeah, I don't know. I mean, the price, we've seen some repricing. It's usually 5 to 15%. And so other asset classes, I think, have seen upwards of 20% repricing in assets because of this interest rate movement. When we look out 6 months, I think the spreads have to come back in. These lenders have to start putting out money again. Their balance sheets are generally in good shape. So while the index is up, I think the spreads will, I hope, I'm not trying to predict which way interest rates are going, but I hope the spreads start to come in. And to Kevin's point, there's a long run of history where people in the hotel business have made money with expensive, like debt, much more expensive than other asset classes. And people just got punch drunk on, free money basically for the last decade. Yeah. So, again, on this portfolio we're selling right now, we've got REITs and family offices that have said, we're just going to take it down all cash. And these are several $100 million assets, or they'll get a signature loan from their private wealth management group, and so they're able to manufacture, a high single-digit return on it. And that's okay for them, because they just want to own it forever.
Punch joke. Okay, So let's single out Dallas-Fort Worth for a little bit, and Texas in contrast to the rest of the country. How do we fare? How do we stack up against other major markets?
Yeah, I mean,
And this would be a good question for you, Kevin, but let's start with Dupree.
Sure. I mean, there's a big difference here than the rest of the country for sure. There's a macro story that that I think lenders, that equity partners, that even brands, that people really see. I mean, Dallas-Fort Worth is really the leader of that for sure. But when you have the type of corporate growth that we have, when you have the type of educated workforce, when you have the type of population movement that's coming here, the ability to get things done politically, that's a game changer in terms of how institutional groups look to invest. And so you're seeing markets even where you would have thought. Now, San Antonio has always been it's been a great market. I think locally we see it as a bigger market. Nationally, it's kind of always been seen as more of a second-tier market. That's not the case anymore. I mean, a place like San Antonio is garnering more attention than some of the traditional markets you might have seen across the country. So from our perspective, it's really been a focused, intentional effort to say, we've got all we can eat right here in the state of Texas. And so I've been on a Southwest flight more in the past 12 months than I have been in the last 10 years, just because everywhere we're going is within an hour reach of Dallas. So that's been a focus for us. I'm sure on the transaction side, I'm guessing, at least that's been the case for us, like, there's actually been a resilience in pricing here different than we've seen in other parts of the country.
Yeah, we've for 10 years, we've been saying, follow the jobs, follow the people. Like, there's a reason to be here. Most of the hotel reach had kind of redlined Dallas, actually, until recently. They're now looking and trying to find the one or two assets that will get them back into this market. Austin is on every major investor's radar. They all want a dot on the map. And to Dupree's point, San Antonio has definitely benefited from the growth in Austin and is looked at as like kind of the next tier kind of growth market in Texas. Unfortunately, Houston's still like a little bit of a challenge, except for like specific pockets. The Woodlands is actually performing phenomenally right now in Springwoods and other places, where some of these micro markets in Houston are actually much better. But the overall market is just painted with this brush that institutions are not wanting to kind of jump back into that market yet. But Texas is a great place to be right now, especially in the hotel space.
Yeah, and I'll give the outsider's perspective, and I'll use a term of art: on fire. I mean, Dallas, Texas, it's unbelievable. And I say this as someone I've been living in New York now for 20 years, and I think, COVID has really exposed a number of the challenges that some of these blue cities, blue states have with unions and regulatory issues, taxes. It's really fascinating. I mean, we've seen, obviously, the Dallas and Austin and Miami and Nashville, these what we call the darling markets, have performed extraordinarily well. You've had strong job growth, strong population growth. I think that's going to continue. As I look at a market like Dallas, for example, which obviously has been a big city for a long time, but I think as the number of finance jobs and technology jobs increase, you start to have a network effect where the more you have, kind of the bigger the benefit, and the more people want to come. And I think what happened post-COVID is the Zoom effect, and the fact that a lot of people can generally work from anywhere, makes it a lot easier for people to be here. One sort of change in perception, in perspective, which I think is critical. I think there used to be this perspective that if you're in financial services, you need to be in New York. I want my banker in New York. Now people know, as long as your banker has relationships in New York and contacts and can get stuff done, there's not this expectation that you have somebody sitting in an office at 42nd and Madison doing the work for you. And so I think clients' perceptions about where they need their service providers, professional services providers to sit is very different. And so I think markets like Dallas and Miami and Nashville, Austin will benefit tremendously from that. So there's a real mind shift, that change in sentiment that I think has taken place. And I think Dallas has, bright, bright skies ahead.
We are turning into a formidable financial services market too.
Absolutely.
Financial services companies expanding and moving
here. It just continues, right? And the more you have, the more that gets built up. And then also you add in the cultural components, the art scene, the food scene, all of a sudden, and then cost of living. And I know it's run up, but you know, the cost of housing significantly cheaper here than a lot of other markets. And so, I like I said, I've been in New York for 20 years, and I remember I was a VP working at an investment bank, getting paid, you know, pretty good money, but like I could afford a house in Brooklyn as a VP, kind of lower level, mid-level guy. Now you have to be like a senior managing director, and even then. And so there are a lot of people, highly educated professionals that, you know, used to live in a place like New York or San Francisco and LA. They just can't afford it.
Yeah.
But they want good jobs, good community, they want a good food scene, they want culture, and Dallas offers that. And so I think, like I said, I'm really bullish on Dallas longer term. I think, you know, I think it's amazing. So.
I want to go.
Yeah.
Sorry, I want to go back to one thing Dupree said, which is on the price point of hotels in Texas and in Dallas. We're finally getting some pricing power in the hotel space like we've never seen before. And so, you know, in hotels, the general metric is RevPAR, which is revenue per available room, and our RevPAR is at an all-time high. That also translates typically into higher profitability, and that's translating into higher price per keys. Like Dallas used to have a $200,000 a key barrier on a price per key basis. Like nobody would ever pay more than that. And now we're making trades at $850,000, $900,000 a key at like way above replacement cost. And even your kind of entry level, like really, you know, well-built, full service hotel is probably $400,000 or $500,000 a key today. And we could make the argument that's actually below replacement cost. But the pricing point has like doubled on getting into, you know, markets like Austin and Dallas and San Antonio.
All right, well, let's shift gears a little bit and talk about development. Maybe talk about supply and demand, talk about development activity, what the challenges are, how the land situation is, and you are the man to answer that question, Dupree.
Yeah, well, we can talk to Lynn about land for sure, but I mean, it's the same effect that you see across the board is happening here in Dallas, but in particular, when you look at North Texas, what's going on near Frisco, what's going on up there. I mean, the land prices have not doubled, but tripled. And in other forms of real estate, you can, because of rent growth, you can control that. In hotels, that's a little bit harder because I think you have seen a lag in RevPAR growth where it is just now starting to really ramp. And so those rates, when you're trying to develop a hotel and prices are going up 20%, and interest rates have now gone from 3% to 6.5%, that becomes a real challenge to make development work. Again, I think it's a pretty simple equation. Either you're willing to accept a lower return in development, which I think in most cases what's happening for developers, that's where you make your money, and where you know, kind of how you keep the lights on. At the end of the day, you just kind of have to say, well, in terms of risk adjusted for us is a little bit different than what that risk adjusted return might be for someone else. And so for a group like Woodbine, we say, well, we're going to keep developing. And so we have 3 projects that will start over the course of the next 12 months in the development space. One that we started 2 weeks ago or maybe a month ago in San Antonio at Hyde Hill Country. We're doing a $90 million renovation there on that asset. And it was kind of like you're looking at all the metrics from a macro perspective, and you're saying, okay, what's going to happen over the course of the next 2 years? If there were ever a time I'd want to be under construction, it would be right now. And so we look at it and say, well, we built the balance sheet to be able to develop whether we are in a great market or whether we're in a bad market. And so from that perspective, we kind of have to stay true to our North Star and say, this is what we're going to do. We're going to keep going. So for us, it's one foot in front of the other, a little bit with blinders on, but we're just going to keep marching ahead. And I think that gives us a competitive advantage when the large majority of developers are saying, we can't get it done. There's not equity that's going to accept those lower returns. Debt guys are pulling back, going from 65 to 55%. And ideally, that puts us in a position on the other end of this, whenever that is, where we've got new product. And I think that historically has been a winning strategy for us, where supply is going to be muted, and you're kind of the last man standing, or at least that's the idea. You guys.
What types of projects are you working on? And overall, I would say for development, what's attracting the most interest right now, and how does supply and demand for space kind of line up?
Well, select service has been the darling of the industry for a long time. I mean, there's kind of a joke in our industry. There's a reason like the select service owners and hotel developers have airplanes and the full-service guys don't. We've always been full-service guys, so that's why I'm on Southwest, I suppose. But I think we've over the last 10 years have really shifted into the select service market. So select service, I think everybody probably has a grasp of it, but Hilton Garden Inn, Courtyard by Marriott, Hyatt Place, those types of assets, a lot more efficient operating model. When you're going into this type of environment that we're going into, or that we've been in even, I mean, margins become really, really important. In a full-service hotel where you've got staff that's much larger, where you've got bell, where you've got food service, where you've got all these other things, it becomes a lot less efficient to operate that hotel. And so that has been a key for us, is really growing that side of the business. But again, there are places where it's going to make sense. Right now, we're doing a coastal market development deal, full-service hotel, and for us, that's kind of one of the few markets where it's going to make sense, because as John said earlier, that's where you're going to get that RevPAR growth, a destination drive-to or jet-to leisure market where you're going to actually see the type of RevPARs that you need to justify development. So that's kind of where we're seeing some of the windows that'll work.
Okay, great. What are you guys seeing on development? Sam?
I'd say the cap, like from the institutional world, there's very little appetite to do development today. Like equity for development is predominantly in the select service space, and it's mostly private, on the private side. And then, again, I think phenomenal firms with great reputations like Woodbine can still go out and get construction financing. And so that market's probably actually much easier than the equity market. But look, the development market, I think it's more than just land basis. You really have to pick your spot, and you have to know like accessibility, like what's traffic patterns, like how is somebody going to get in and out of there, and is that going to be a pleasant experience? And then once they get there, like what amenities are you offering? And so it's properly planned, properly developed, like they're absolute home runs. But we joke, it's like, how do you become a multimillionaire in hotel development? You start off a billionaire. And it's like, so it's tough. It's not for the faint of heart. But the guys that do it well, I think they're really rising to the top.
Yeah, I would just add, I mean, I agree with everything John and Dupree said, and kudos to you guys for the projects that you're getting off the ground. I mean, we, just in the hotel space, hotel mixed use, we probably have north of $2.5 billion worth of development deals that we're working on right now, and they're all incredibly challenging. We've been selective in terms of the types of deals that we've taken on. Best assets, best markets, best sponsors. And this was a thesis that I sort of took on, I don't know, a year ago. And with that focus, and even then, it's been tough. And frankly, all of those campaigns that we took on 9 months, a year ago, save one, we're still working on. A lot of them involve JV equity, which is really tough right now. The financing is marginally easier, but still incredibly tough. And again, these are some of the best sponsors, great assets, and great markets, and it's just hard to get done for a variety of reasons, one of which construction costs much higher. And it's if you look at where trades have gotten done relative to some of these development deals, the cost to build is higher than where the highest price per key asset is traded. So lenders and investors are a little bit, there's some sticker shock there. So I don't need to belabor the point, but it's really tough.
One other data point I'd add, this, but it's unbelievable some of the debt that these developers are taking on. Several of these debt funds are putting out quotes at 850, 900 over, and they're getting signed up. And so that advance rate is 65% on a construction deal at, 12% debt? It's unbelievable. Yeah.
That's the best risk-adjusted part of the capital structure to be in right now is, I mean, the debt side, if you can do, mezz debt again, 8-9%, you're getting a low double-digit return all in, 8-9% on the spread, a low double-digit return all in, and you're, in construction, you're taking, 65% risk, maybe 70% risk, and on existing assets, you're probably, 75% risk. But again, for an all-in low double-digit return, it makes a lot of sense. And people are taking it. I know you know.
Not you.
All right, well, as we all know, there's a war for talent going on, and hospitality has been particularly hard hit, even as the industry tries to emerge from the pandemic and is, doing good in that realm. But how is talent and hiring and the job market. How is this impacting service at hotels? Dupree, you want to start?
Sure, in a big way. I mean, there is, you had I mean, kind of the necessity of the pandemic, a sad necessity was you had to cut teams. I mean, I think in our hotels, at one point there was probably 50 or 60% of the staff across our entire portfolio, probably a little bit more than that actually, that you had to completely say, furlough or let go. And so I think a lot of folks in that industry said, well, this is not a sustainable model. Let's go find work elsewhere. In a lot of cases, I'm not sure, we've tried to kind of figure that out. There's not a really clear path or consistent direction of where they went. I mean, there's different Amazon, insurance day one, right when you work, DoorDash. I mean, who knows? There's a bunch of different things where people went. And so it's been really hard to get people back in the industry, I think service industries in general. And then really you're kind of taking day wage folks where you're, gig type hiring even on the hotel side. So you don't really have the ability to train like you normally would, really high turnover rates, all those types of things. And you don't have the same volume of customers. And so it makes it a lot harder for them if there is some type of tip component for them to supplement their income with those, those types of wages. So by and large, you've seen a big challenge there for us to be able to provide the service we've historically provided. So that's where you've had to get much more creative. But from that, it has been a challenge hiring, and I think that's something that's going to persist for sure. All up and down the ranks of hospitality. It's not an easy business to work in for sure. I think too, on the investment side, even when you think about who we're hiring now, it has become much more competitive, even across the commercial real estate sectors, to where bringing folks in, even on the investment side, has been harder. So it's not just at the hotel level; it's really up and down the board for us.
No, but I think that's probably my biggest concern for the hotel industry going forward is the staffing. It's been unbelievably hard for people to get cooks, wait staff, housekeepers. We were just at this lodging conference I was staying, and they didn't do overnight service. They did it on checkout, right? They would clean your room on checkout because they didn't have enough housekeepers to clean every room every night, unless you specifically requested it. And so that's indicative of, you're used to coming back to your hotel room and having a freshly made bed, and it wasn't done. And you just have to get used to it and accept it. The other thing I'd say is it's going to start affecting the margin. We did benefit from less staff, less overhead, and now as they start to try to hire people back, they're having to pay a ton more. So a housekeeper used to make $12, $13 an hour. They're now offering in Austin, as an example, we're working on the Line Hotel. They're offering $21 an hour, and they still have 1 or 2 open positions. Mm-hmm. I mean, it's unbelievable. It's like, where'd these people go? I don't know what they're doing.
Nothing else to add.
Yeah. Well, since you all just returned from the conference, I'd love to hear, I'm sure we would all love to hear, was there anything that was especially surprising or interesting? What kinds of learnings stand out from the gathering?
I'll lead off quickly. I think I was surprised at how maybe there's kind of the Texas, kind of bubble that I've been in, but seeing and talking to a lot of the national groups, especially those that are invested in other asset classes, and having conversations with them, I have been surprised at how anxious people are about what is coming. I was talking to the Wells Fargo guys who have said that the loan that we did in San Antonio is literally the last loan that they've done in 2022. And there is a lemming approach with lenders where they'll say, hey, if they're stopping, we're stopping. And so you've seen this really huge, kind of wave of ceasing activity on the lending space, at least in hospitality. And so I think there's this thought that we are in for a crash landing here. I think generally the prevailing thought that I heard was it may be mild, and it may not be that deep, it may not be that long, but we might be in for a crash landing here pretty quick. Now, I'm usually the optimist of the group, but after hearing enough opinions from folks who, again, have other investments, who they're saying, hey, we're giving concessions on apartments in Boston, in Miami, And those are things that Texas just hasn't seen yet. And so I think from that perspective, I'm started to make me a little more, nervous about what's coming for sure.
Yeah, it is easy to stay in the Texas bubble, for sure, which I think actually is an asset for us. It helps with
For sure.
our optimism.
It does.
What about you?
Yeah, I think we're going to feel our way through this. I mean, I didn't walk away from the conference with any consensus. I think some people are reasonably optimistic, some people are bearish, a lot of people are wait and see. Someone made the point earlier, I think it was John, which is really valid. I mean, look, we didn't go through a recession in hospitality. We just came through a depression.
Yeah.
Okay? And we're on our way back. So what I would argue is that there's a decent chance the economy will slow. I don't think there's any debating about that. But look, there's a decent chance that maybe the ramp back up for us isn't as strong as it would have been otherwise, and maybe it gets protracted. But I don't know that we necessarily take a lot of steps backward. And if we do, it certainly won't be to the same degree that we did before. So I think there's a resilience within hospitality. I think overall people feel okay, but they're concerned, obviously. There's also been an increased discussion about distress. Now, what's fascinating, when COVID hit, everybody was expecting a tremendous amount of distress. It never came. And so now, as we face this higher rate environment, people are like, yeah, maybe there will be some distress. But I don't hear as many people talking about it. And in fact, right now, though, I think it's going to be far worse. And there's far more reason for us to believe that there will be distress. Primary reason being, before, we had the Fed pumping an additional $4 trillion of liquidity into the economy post-COVID, Congress adding a couple billion with fiscal policy. Now, the Fed's going in the complete opposite direction. Yeah. So if ever there was a time to think about distress, it really is now. And again, I mean, we're talking about 7, 8, 9% rates for good assets, institutional assets. That's where people will have to borrow. And so for some hotel owners that have loans that are coming due and they're paying, they may have gotten it done at L300 and they were paying, 310, 3.25, but they're looking at a refinancing at, SOFR 500, 600 over. So potentially double-digit cost of capital. And for those that don't have the wherewithal to refinance at full proceeds, they'll have to recap, they'll have to bring in preferred equity, rescue equity, and or sell the asset. So I think that's going to trigger a lot of activity. So look, it's again, I think sentiment's kind of all over the board. I'd say cautious optimistic on the operating performance perspective, but it's going to be a lot of interesting things that take place over the next 12 months as we readjust to the new environment.
I walked away quite a bit more positive. I mean, just even by the attendance. Like the lodging conference is a secondary, in Phoenix, it's kind of a secondary conference to New York and LA, and the attendance was, I think, an all-time record high. And I think that's because people, again, that added interest and people trying to get into the space. I love your analogy about, do you want me looking back or looking forward? Because I think most of the people I talk to are looking forward. And yes, deals are tough, and they're tough to get done today. Some deals are falling apart. But for the most part, everybody's looking ahead, and they're trying to figure out, how can I get a deal done, and what's my cost of capital, and what's my pro forma going to look like? And I still want to invest. It's a place I want to be in. So there wasn't, I would say, private equity, institutional private equity has definitely gone negative. And so when Barry Stern looks on CNBC and saying we're going into recession, like, if Barry's negative, Starwood Capital is probably not doing a deal anytime soon. And so you got to look somewhere else. The REITs their balance sheets are pristine. They've got more cash on their balance sheets than they've ever had. Like, they're ready to play offense. That's got to be priced right, but they're ready to play offense. And so I still think there's going to be a transaction market, but it comes down to pricing.
All right, before we get to audience Q&A, another question on everyone's mind is business travel. We've seen revenge travel. We've seen a lot of leisure and bleisure, as we spoke about. But what about business travel? What are you guys seeing? What do you expect?
I heard a new term the other day that I liked. Instead of bleisure, they're calling, somebody called it mullet travel, which I think is great. They're saying business in the front, party in the back, which I think is That's great. I'm great with public travel. We are seeing it. I mean,
That's going in my next pitch.
that's right.
There you
Make
go.
sure that's there. I think I've brought a lot of institutional terms to this panel.
Yeah,
There you
that's right.
go.
But it is. I mean, it's traveling midweek that then extends into the weekend. I think that's important for us. We're seeing places that didn't have leisure historically. Now we have some of that. So I don't think that stops. I think that's going to continue. I mean, if you look at like the percentage, the income of travelers, 60% of travelers in hotels have a median income of above 100,000. 40% have an income above 150,000. So when you kind of think about the recession that we could be going into, that's where I think we have a pretty good hedge. I think there's some protection there in our occupancy because of that. So I think on the group and side, I also think that's a segment where historically you would say that's the first to go. But I think the way people work now, remote, I think that changes the way people meet. Now conferences and even these smaller gatherings become much, much more important. So I think there's actually a case to be made that group is actually a little more resilient than it may have been in the past because of what's happening and because of how those dynamics have changed about how people work.
Interesting.
Yeah, it's interesting. If you talk to the experts, they'll tell you, well, business BTs could be off 5 to 10% longer term, and maybe as historically categorized. But I think that historic categorization is no longer accurate for the reasons that Dupree mentioned. And I've been saying this a long time. Look, COVID, the emergence of hybrid work, remote work, has really been a game changer. I don't know that we fully appreciate what the implications are going to be longer term, but look, people have more flexibility, and with more flexibility, that facilitates mobility, and greater mobility is good for travel. So if you ask me net, what I think the implications are is more people are going to be traveling. I can't tell you if it's leisure transient or BT or group. There are going to be more people staying in hotels. But I think with the sort of mullet travel dynamic, it's true. Look, people they'll go to a market, they'll stay for a couple days, do business, and then hang over the weekend. And if you look at the average length of stay, it's increased by a day post-COVID compared to 2019. It seems that Wednesday occupancy has gone up, Sunday occupancy has gone up, so people are checking in. Clearly, they're staying longer. So that's a good thing. I think that also harbors good things for the extended stay space, which has been incredibly strong post-COVID. There have been a number of extended stay deals that have gotten done, large portfolio deals, and I think that will continue. I think there's just going to be this blending of work and travel that will continue, and again, net, I think it's a positive for our industry.
Yeah, I hope that there isn't this massive slowdown or kind of backtracking on the progress we made. With the kind of more macro outlook next year. But I mean, when you look in Austin, Texas, when you look in like Dallas after Labor Day, it has been gangbusters. Go try to get a room anywhere in Plano and Frisco on a Tuesday, Wednesday night. You can't. Business travel is already back there. Wow. Group is back. Austin, Texas, same thing. You can't get a room. If you are, you're paying $700,000-800,000 a night. The hotels, we're working on a couple projects, one in Austin, and every time I've been down there for property tours, all the meeting space is booked. And it's tech companies, financial services companies, it's some social organizations, and then they're backfilling with this leisure traveler who's extending their stay, and then the business traveler who has to come there for either for sales calls or whatever he or she's going down there for. So we've got a lot of occupancy growth right now, and actually there's another point I think that we shouldn't gloss over. We learned in COVID, if somebody's not going to show up, don't sacrifice rate. And so I don't expect our rates to backtrack. Right?
So
I agree.
That's going to be important.
The rate, we need to maintain our rate integrity, because if they're not going to stay in your hotel for $100 or it doesn't, or for $200, it doesn't make sense to cut it down to $100. So I'm still optimistic. We're going to keep the occupancy. Hopefully, we'll maintain our rate, and then we'll deal with the interest rate issue.
Okay, great. All right, we have a couple of minutes for questions. Kim? Mike?
We have a vote coming up on the convention center. I'd love to hear Dupree's opinion on the convention center.
Sure. So the question was about the convention center. I'll do like shameless plug. Everybody go to vote yes for Prop A. endorse it today, endorse it for your company, for your mother, for your cousin, stepbrother, anybody you can. I mean, there's a long list of supporters for that. I'm passionate about Cotton Bowl, and I'm passionate about Fair Park in general. We all should be. It's the greatest collection of mid-century art, Art Deco art in the country. And this is a much-needed improvement for that. So it's $300 million that would go to Cotton Bowl, to the Coliseum, to the band shell, to places that we actually use. So that's critical. I also think that does a lot for South Dallas. I think there's a real legitimate case to be made that as Fair Park goes, so will South Dallas go. Secondly is the convention center. I mean, most of us have probably traveled to Nashville. Most of us have probably even been to San Antonio after they did their convention center a couple years ago, or a little bit more than that. There has been a night and day effect on those cities. And I'm not necessarily comparing Dallas to Nashville, because they clearly have a lot of mojo with the music scene and everything else. But there's a statistic-driven case to be made that if we improve that convention center, and we spend $1.5 billion on it, that it will change the course of downtown. And so I'm a passionate believer, and as a hotel owner who's saying, okay, I'm going to subject my guests to a 2% increase. Nobody here in this room has to pay a dime. But for my guests to come and stay in my hotel, pay 2% more on their bill, and see another tax line on that, for the hotel community to say we are 100% for it, that's a big statement. And I think that's something that says, look, if the hotel community is for it, then that's something we all ought to be able to get behind. So I'm pleading to say go endorse it on that website, talk about it, tell people to do it. It's an easy one. It's a hard vote in November at the very end of the ballot. That's a challenging place to be in. But for what that means for Dallas, and what I think that does for downtown, what that does to connect us in a way that historically has been really challenging, I think it's literally a game changer for us. So I am very passionate about it. I'm glad you asked about it, but I probably said enough.
No, I'll just jump in too. We have to get it done. All the great things Dallas has going for it, our convention center is an embarrassment, and we're never going to be competitive with markets like Orlando and Nashville. Even San Antonio is probably kicking our butt right now because of their new convention center. So we've got to get it done. It's not going to cost taxpayers, and it's going to be a game changer for the next phase of our kind of economic growth cycle.
All right, Kim, did you have a question? I did, but I think we need to end on. Yeah, okay.
Okay, good.
All right, can you please join me in thanking our exceptional panel? I hope you all enjoyed it. Thank you guys so much.
Okay, thank you everyone. I really wanted to thank TREC and Real Estate Council for putting together such an insightful sessions for us. Also, thank you to all the panelists. I'll tell you I know we're a little over the time, but my recent visit to hotel was last week I was talking to somebody before the session at Chalktown Casino, and it was fantastic to see their new tower, but at the same time, it was so nice to see a number of people who were there, not for the conference, just the hotel guests. So it really felt like we were a little bit coming back to kind of what we were pre-COVID. So again, I'm Rena Parikh, partner at Grant Thornton, and we are so proud to continue to sponsor these programs. Just a little bit on Grant Thornton, we are a global firm providing tax advisory and audit services, and we have a dedicated professional team standing by to help support dynamic organization as they are growing, and so definitely do make us part of your growth journey. So once again, thank you for giving us a few minutes to talk, and I'll hand over to Linda to make some closing remarks.
Well, thanks, panelists. This was a great program. I stayed in a hotel earlier this week, and the service issue is a real problem, but I do see it's not affecting people wanting to go to hotels. So we really appreciate this, and a big fan of hotels. I really thank all of our attendees today. Thank you for being here. Thanks to Grant Thornton and DCEO, and Christine, we can't do a program without you because you're the best in moderating all these great conversations. Just a couple of quick notes. It is North Texas Giving Day, and so we're giving you a gift, and you can give back to us if you'd like, but we are giving you your valet complimentary today, so just want you to know that. But make sure you take a snapshot of the QR code on your table and help us do the work that we do in the community by supporting Trek Community Investors, so I appreciate that. We have a great fall lined up. If you're a member of our Political Action Committee, and you have to join to be part of that, we're going to have a great conversation moderated by Todd Williams with the new superintendent of DISD, and George and Lindsay Billingsley have graciously opened their home to us for that event in a few weeks, so stay tuned for the announcement. We'd love to have you there so you can learn what's happening in our school district, but you have to be a member of the Political Action Committee, so you have to go online and join. And then we will wrap up the year with a great capital markets update by Mark Gibson from JLL, and we can't wait for that. I'm sure by November, we'll have a lot of things to talk about, given yesterday's announcement with the Fed. Thanks again for attending. We look forward to seeing you soon, and hopefully we'll see you next Thursday night at Fight Night. Great.